start. This is going to be a kind of short class. Okay, so we have one topic, and several students have asked me for starting at 6 more or less. So let's run with a class. It's a short class. You're going to see it's simply applying what we have learned up to now. Do you see my screen?
Yes.
Great. Great, guys. So what the topic of the class today, guys, we are almost there. So the topic of the class today, what is my, 1 second. Here we go. So the topic of the class today, guys, is long-term debt that is known as bonds, okay? Now, so let's talk a little about where we are in the class. So remember this is my balance sheet. Do you remember that? So we said all this part here are my assets, short-term assets and long-term assets. So this part here. Then we say that we have liabilities, and then we divide the liabilities into 2 pieces: short-term liabilities and long-term liabilities. Okay, and shareholders' equity. So up to now, guys, we have learned interest rates and how to manage interest rate, how to get mortgages, loans, IOUs, discounts. We have learned how inflation influences your finances, and exchange rate, how you can manage exchange rates. Got it? So all the techniques that we're going to use now, guys, have been used for everything, but we're going to pay special attention here in this type of debt. Okay, so anything that is long-term is in accounting is larger than 1 year. Right? And in general, guys, bonds are larger than, and maturity of a bond is larger than a year. So here is what we're going to consider. We're going to understand how bonds work and what is the relationship with bonds in the corporation. Right? So in general, guys, corporations are ranked. Do you agree? There exist credit ratings. And these are important, credit ratings. Okay, so corporations are simply measured in terms of the likelihood of a bunch of things. One of them is likelihood of default. Right? What is the likelihood that you're going to be defaulting this year? What is the likelihood you're going to be defaulting next year? And all this is based on a bunch of risks. You have liquidity risk, you have operational risk, you have a bunch of risks that basically create a rating for an agency, for a corporation. Right? And there are the well-known rating agencies are Standard & Poor's and Fitch. So they have one special type of doing credit ratings. And the other one, of course, is Moody's. Right? And then these guys have the notation is, for example, we have AAA, AA, A, triple B, double B, B, triple C, okay, well, simply double C and C. And these guys are, Moody's is A, AA, AA, A, BAA, BA, B, and CAA, CA, and C. Okay, and Moody's, SP500 and Fitch guys has something that is called D. Okay, in general, what we divide this one in the following way. So we have all the corporations that are above this one here, so all up, are called investment grade. All the B's below this part here are called speculative. And the bonds that are below are called junk bonds. Okay? And this is important, guys. Why? Because the price of the bonds depends on what this rating is here. Okay? And something that is really important, guys, is in terms of understanding how this works, is the valuation. Do you agree? What is the valuation of your corporation? And how do you think that one important piece of valuation is, of course, is based on fundamental analysis, right? So you have an analyst that analyzes what you're doing, what is your business, what are your projects for the future, does discounted cash flows, etc. So they arrive to a price. But also there is one indicator, guys, that is crucial for setting up the prices. What do you think is this indicator? Where do you get prices or valuation of a corporation? An idea of the valuation of a corporation. Where do you get this? For example, guys, if I tell you guys, what is the market value or the fundamental value of Amazon, for example? Someone can give me a number. Per share, just to make it easier.
150 shares.
The value is given in terms of dollars, right?
Mm-hmm.
Okay, so you said, Matt, so I'm talking about Amazon. So for example, who can give me Amazon? Who can give me the value of Amazon? A fundamental value. Of course, if you do the real fundamental analysis of Amazon, you need to go to the books, talk with the CEO, CFO, check distribution, check all the businesses that Amazon is, etc. So you need to do a very robust analysis. But also there is another indicator. So this is called fundamental analysis, okay? So everything that I mentioned to you is the basics of what is called fundamental analysis. And the fundamental analysis, we come up with a valuation. Another way of valuation, guys, and the people use this a lot, is taking a look to the market prices. Do you agree? So market prices, what I mean is stock exchanges. Garrett, I think today Amazon's price was 3,000, almost 493, something like that. Got it? So now, this is the price that the market is willing to buy and sell today. Okay. So and one of the advantages of the stock markets is that these provide, as soon as we are supposed that these guys are professional traders, that they have done their fundamental analysis, etc. So what the people argue is that exchanges provide a service to the community because they provide an insight about the fundamental value of the corporation. Okay, these guys is completely, you know what, you need to make your own decisions. But Amazon was last year, then it collapses here with the coronavirus, and then it went down, it went up, it went down, and now it's going up, went down, and now it's something like that. Okay, so Amazon has a valuation. So and Amazon is one of the stocks that a lot of people do fundamental analysis, really. And so they say that the price of Amazon, for example, is going to be around $4,000. Okay, so and the trend today that is at 3,493. So yeah, it's going in that direction in time. Got it? But Amazon is one of the corporations that is really understood and studied, and is well known. However, what happens? Have you heard about GameStop? Have you heard about that? Guys, 2 or 3 months ago?
Yeah.
So what happens? So it basically 400%. So the price was almost nothing, and valuation was terrible. And then suddenly, there was a noise that simply says, you know what? There is a lot of shorting people here, so let's go against them. And technically, guys, this stock went 400% in a couple of days. It was there for 100%, going down like that, went up, went down, and now it's almost there. Got it? So what happened? Why this happened here? So this was done basically, guys, but something that is called fractional trading. So there were a lot of individuals. You know what is fractional trading? Now, guys, imagine that you want to buy Amazon, okay, and you have $3,000. Are you going to buy one share of Amazon? Let's say you have $3,500. Are you going to buy one share of Amazon? Yes or no? It's too risky, right? Because you are going to put you're going to put all your money in Amazon. So remember, if you remember your finance classes, don't do that. Basically, you try to create a portfolio. But if you only have $3,500, so the only option that you can have is go into a mutual fund and try to find a small piece of the mutual fund and try to invest in Amazon. However, guys, now what is happening in the world now is something that is called fractional trading. So instead of buying one share, so this is per share, instead of buying one share, guys, you can buy, for imagine 0.01 of a share. Got it? So basically, with $34, you can buy a piece of Amazon. Got it? So what is the interesting part of this one here? Fractional plus technology. So what is happening now? Technology. What is happening now? The action, so that the access to the markets, okay, can be done not only by professional guys, but can be done by anyone. Okay, so in technology, we have, for example, Robinhood. Have you heard about Robinhood? Have you heard about Robinhood, guys?
Yes.
Yes, yeah. This is a trading platform. You know, Interactive Brokers also now is opening its platform to do fractional trading. So basically now you don't need to be a professional trader. You can have your laptop or your cell phone, and then you can start trading. Now, what is interesting, guys, is that the volume of fractional trading has grown so fast that they are able now to move the prices up or down or whatever. So now we are in a world now that the people that we study the markets, we are in a world of complete ignorance. So we really don't know what the price is. So what is the price of GameStop? The fundamental value of GameStop is more or less this price here, but sometimes the prices go up, go down. So it is a complete confusion. So that's why now, guys, if you go and this happens in real life, now more and more the banks or the lenders are not using this type of information because it's so volatile. So many things happen in the market that there is no explanation for them. So one of the advantages of having stock exchanges, you know, besides liquidity provision and market price discovery, is that there is no trust anymore in the market. Okay, I don't know if you heard before, you know, the markets look like a big casino, and apparently that's more real now than before. So and this piece of information, guys, is crucial because, you know, not all the corporations have a rating, and not all of them are rated. So, and some of in many instances, the lenders look at this value and then they say, you know what, based on this value, I see that you're growing. I see that the market is valuing very well. You compare this value to your book value, and then you can more or less get an idea of what is your future. Got it? But now this is being lost, and it's being lost. This affects not only the exchange market, stock exchanges, but also affects real corporations. So affects this part here because now valuation on the stocks, valuation or understanding fundamental value of the corporation is much harder now. Got it? So in any case, we're going to assume that there is some information that allows us to set up the prices of bonds in a correct way. Now it's trickier than before, but let's assume that we still are in a position that we can value stocks. Okay. Now let's take a look to the components of the bonds. Okay. So the bonds, if you see a bond, guys, I will do only the easy bond. That is a bullet bond. So the bond has this particular structure. For you, it's not going to be anything new. So here I have this one here, and I have this one here. Okay. So this one here, guys, is called face value. Okay. It's also called principal. Okay, and it's also called par value. These small ones here are called coupons. So coupons, guys, are interests. And how do you compute the coupon? You compute the coupon with a small c, that is a coupon rate. Okay, so this one here is an interest rate. And how do we call this one here? We call this one here P, price, or also present value. But normally the people use price. Got it? So this is, so how do you compute this price, guys? Any ideas about how do you compute the price? Do you recognize this cash flow here? We have done in IOUs, we have done the opposite. Remember, I receive money and then I make payments like the how do you call it? The mortgages. Remember, we have done that. This looks exactly the same, but reverse, right? I put money first and then I receive payments that are constant in time, and then I receive a final payment that is equal to the coupon, last coupon plus my principal. But you see that this is the formula. This one here looks like a mortgage, right? Yes or no? Guys?
Yes.
Yes. So if you remember the formula, guys, how do you compute P? P is going to be simply equal to my coupon, my payment, 1 plus I to the n minus 1 divided by 1 plus I to the n times I, plus I need to modify my future value or my face value divided by 1 plus I to the n. So this is the way we're going to be pricing bonds. It's very straightforward. Okay, simply a regular cash flow. Okay, now this T is called maturity. How many years, how many quarters, when it's gonna end, that's called maturity. Now, there is one concept, guys, that you need to understand, is what is called the yield. Okay? And everyone talks about the yield. The yield, guys, is simply equal to the coupon divided by the price. Got it? So the yield, and this is important, is a function, coupon positive and price negative. And also what is interesting, guys, the price is a function in terms of the interest rate, and it's a negative function. So this interest rate is normally the Fed rates in USA. Okay, so based on this, what happens is the following. If the Fed increases interest rates, the prices are going to decrease. Do you agree? If the prices decrease, what happens with the yield? What happens with the yield, guys?
Increase.
Increases. So this is good for what? Buyers or sellers? For buyers, do you agree? Because the price is going to be lower. Make sense? Now, if the interest rate decreases, so what happens is the price is going to increase, the price of the bond increases. So this implies that my yield is going to decrease. So this is going to be good for sellers. Help see. Right. It's going to be good for sellers. Okay, makes sense? So the yield is a concept that you must understand. You need to understand that people talk about yields. But yield, guys, is a concept that it is dynamic. It is not a yield that is going to be stable for all the period, for all the number of months or quarters that your bond is being traded. Okay, yield indeed changes, but this measure here appears to be static. Okay, and indeed it is static written in this way. But if price changes every single moment, coupons could not change. So they are fixed. They can be fixed. But prices changes all the time because interest rate changes all the time. So if interest changes all the time, prices changes all the time, and yield changes all the time. So you just need to be careful about that. Okay, questions, guys? No questions? Okay, so let me continue then. How do we price a bond? Okay, so let's talk a little about very simple example with bond pricing. So this is 4, I think. pricing. So let's go to small examples. Now, guys, there is one additional element when you have the bond, okay? It's called the yield to maturity. So this one stands for yield to maturity. And this yield to maturity, guys, is simply the market rate. Is what the market is requesting to buy your bond, okay? Or not necessarily your bond. Normally, when the people buy a bond, they buy it based on the ranking, okay? And the higher your rating, guys, the lower the interest rate, of course, because you are more safe, right? The lower you are, the higher the interest rate. But in any case, these rates change in terms of what the market is expecting. So if the stock markets are booming, so the money from fixed income is going to be moving to equity. So this implies that the prices go down. Okay, so there is less interest on buying bonds, so the yield is going to decrease. However, sometimes there is a lot of noise in the market, in the equity market. They move to the bond market, so prices go up, and basically the yield, the people is going to be willing to pay more for. It's going to accept less yield to get the loan, to get the bond. Okay? So the yield is different than the coupon rate. The coupon rate is used for computing the coupons. The yield is used to compute or to estimate the price of the bond. Got it? So that's the crucial element here, guys. Remember, coupon rate for coupons, yield for finding the price of the bond. Right? So how this works, and you help me here, please, guys. I want you to compute the price of a bond, P, and I will do a very simple. Imagine that I have the coupon rate equals 10%. My face value, let's assume that is equal to 100. So what is going to be my coupon from here? My coupon is going to be equal to 10, right? So I will have 10, and let's assume only 10, 3 periods. Here I have 10 plus my return of my 100. So I have period 1, period 2, and period 3. Right? So my question is, what is the price? Now, in order to compute the price, guys, remember what you need. There is one missing information here to compute the price. To compute the price, I need to have the yield to maturity. So this is the one that allows us to discount the cash flows and find my price. Okay? So let's do 3 cases. And you tell me what is the price. Assume that yield to maturity, guys, equals 10%. Okay, in the second case, assume that the yield to maturity equals 12%. And finally, assume that the yield to maturity equals 8%. Okay, please give me the prices. What are the prices? Please do it fast, guys, please. Okay, guys, you tell me. So how do you compute P? P is a net present value, simply, do you agree? So a present value of the is going to be 10 divided 1.1 plus 10 divided 1.1 squared plus 110 divided by 1.1 cube. So what do you get here?
100.
100. Perfect. As you can see here, guys, this P equals the face value. Okay, when this happens, P is going to be equal to face value if and only if the coupon rate equals my yield to maturity. Okay, just remember this. So this is the first lesson here. If C, a coupon rate equals the yield to maturity, then we have face value equals to the price of the bond. Great. So you help me with this one here. So it's going to be 10 divided by 1.12. Remember, I'm using the yield to maturity to compute prices. Plus 10, 1.12 square, plus 110, 1.12 cube. So what do you get here?
95.1.20.
95.20?
Yeah, 0.20, sorry.
Yep, 0.20. This is great. So here, what we have is the following. If the coupon rate is smaller than the yield to maturity, then the price is going to be smaller than the face value. Okay, so this one here is called discount bond. So this bond here is called par bond. This one here is called discount bond. And finally, guys, when you have the yield to maturity is 8%, then my price is going to be 10 divided by 108 plus 10 divided by 108 square plus 110 divided by 108 cube. So what do you get here?
105.15.
0.15. Perfect. So when coupon rate is larger than yield to maturity, the price is going to be larger than the face value. And this bond is called premium bond. Okay, so this one here is going to be called premium bond. And graphically, guys, and you're going to see this graph frequently when you talk about bonds. So this is my maturity time T. Something like that. Something like that. So this is my par bond. This is my premium bond. And this is my discount bond. Now, guys, in real life, two things to note here. In real life, the function is not as smooth as this one here. Unless you don't trade. You buy it here, and then you just keep the bond up to maturity. But if you trade, the path, guys, can be like that. Okay, in real life, but you always arrive to this point here. Okay, and that's crucial. At maturity, you always arrive to the par value. Make sense to you? This is important because the people don't understand that. Okay, so let me do one example. Questions up to here. You understand what is a premium bond? The premium bond implies simply this one here, that the coupon rate is larger than the yield to maturity. So what a bond offers you in the market, sorry, what a bond offers you is higher than what the market is requesting for, is looking for. Okay, now we need to remember that always the final price must be equal to the par value. Let's do one example, just to be sure that you understand this part here. So let's assume that the following cash flow. So yeah, let's assume that you have 10 and then you have 110. Okay, and the time here went here. So you bought your bond here. So let's assume that yield to maturity equals 12%. Can you please give me the price? So imagine that you buy, what is the price at this point here? So this is n minus 1, and n minus 2. So let's say, what is the price at n minus 2 at this yield? Can you tell me, guys? So it's going to be 10 divided by 1.12 plus 110 divided by 1.12 squared. So what is the price here? Someone?
I've got 96.62.
0.62. So this is the price. If you decide to buy the bond here, it's going to be 96.62. Right? Now, what should be the price if you buy the bond here? So it's going to be simply 110 divided by 1.12, right? Do you agree? So what should be the price here? Simply 110.
98.21.
98.21. And then, guys, what should be the price here? If you want to buy the bond the last day of the at maturity, the last day of the life of the bond, what should be the price?
110.
Exactly, 110. Do you agree? So you can see this was smaller, larger, and then we arrived to par. Right? So that's crucial, guys. Okay, by construction, bonds always go to par, unless, of course, guys, unless the corporation defaults. Do you agree? If the corporation defaults or fails to pay or does a restructuring, of course, in that case, that the par is not going to be achieved. But in regular times, when there is no problem with the bond, we always go to the par. Got it? Make sense? Okay, another thing that you need to know when you hold a bond, sources of income. Okay, so let's do a very simple bond example. So imagine, guys, the bond has its life, okay? So, and then you simply said, you know, what I will do is I will buy my bond here. I have 10 here, and then I have one more period, 110. Oh no, 10 here, and then this bond continues, okay? So imagine, guys, that here, you pay 95 for your bond. You pay this one, okay? And this implies, these dots here implies that the bond was settled before, and this continues in the future. Okay? And then imagine, guys, that at period, okay, let's say, I don't know, K minus 1, K minus 2. So you bought your bond at K minus 2. And at period K, you are able to sell your bond. Imagine here you sell your bond at, let's say 97. Okay. Do you understand what I'm doing? So you simply get here, you paid, you bought the bond. You pay 95 and then you have 97. Okay, so what are the sources of income? First of all, what is called capital gains. So capital gains, guys, are simply the selling price minus the buying price or purchasing price. So in here I have 97 minus 95. So I made $2 because of trading. Do you agree? This is my capital gains. The second source of income is basically interest gains. What is called coupons in bonds. So how many coupons do I have? I have 10 plus 10, I have 20 in coupons. And finally, guys, the other source of income is what is called interest on interests. Okay, so this 10 here, so you're gonna keep it for one period. So let's assume that the interest rate in a bank account, let's assume is 1%. Okay, so basically what I'm saying, interest on interest, this 10 produces you 1%, that is 0.1, right? So how much money do you have at the end of the day? You have 22.1. Now, in percentage terms, what is your return? Your return is going to be 22.1 divided by 95 that you invested. Let me see, this one is, of course, if I do this return per period, 1/2, because I have 2 periods, minus 1. So what do I get here? 22.1 divided by 95. This one here to the power 0.5 minus 1. Okay, what do you get, guys?
I got 7.89.
7.89%. Okay, so this is your total return per period. Make sense to you? Oh, my mistake. Sorry, guys. My mistake. Indeed, this is my rate. Sorry. This should be 1 plus this number here. I get a different number, guys. So I get 11.02 more or less. Can you verify this number?
Yeah, I got 11.02 as well.
Perfect. So 11.02%. So this is the total gain of investing in a bond in this structure. Got it? Questions, guys? So let's do some pricing and then perhaps let's do a couple of exercises of pricing, then we can go to the exam, to the quiz. The quiz is very simple, so you will do this very quickly. Okay, so let's go into one example, okay? And you are gonna help me solving this one here. So let's assume the following. Let's assume that this bond pays coupons each 160 days, 360, 540, 720, and 900. So just let's assume this one here. Okay, so the data is here. Coupon rate equals 5%. Principal equals, let's say, $10,000. yield to maturity equals 5%. Okay, and then what is interesting, guys, you buy the bond on day 130. Okay, you buy the bond here. Okay, so here is where I need to set up my price. I need to know what is my price. So let's build my coupons. My coupon, if my coupon rate is 5% per quarter, so this is each 180 days, just to make it simple, and 5% also each 180 days. Okay, so what is going to be my coupon here? 10% of 10,000, so it's going to be 500, correct? I will receive coupons of $500, $500, $500, and at the end I receive my 500 plus my $10,000. Okay, can you please complete the price? Let's say 5 minutes to do this. It's just discounting, guys. There is nothing new, nothing spectacular here. You simply need to discount. 2 minutes, guys, to do it, please. Okay. 1 more minute. Someone has a value? Someone has a value?
I got 10,000.
10,000 sharp. Okay, let's take a look. What I will do, guys, is the following. Remember, discounting these cash flows, I will do this one by one. So this is going to be discounting $500 to the 1.05, do you agree? This 0.5 is this yield to maturity. This is equal to the coupon rate, but we use the yield to maturity. But this one is going to be to the power of what? How many days do we have from here to here? 50 days, right? So this should be equal to 50 divided by 180. Everyone understands that? Guys, do you get that?
Yes, Prof.
Perfect. Okay, so the next one, please, can you be computing these numbers so I do one by one? So this one should be equal to 500 divided by 1.05 to the power 230 over 180. This one here should be equal to 500, 105 to the power, okay, 200 plus 180. Should be equal to 410 divided by 180. This one should be equal to 500, 105 to the power 590 divided by 180. And finally, this guy here should be equal to, this number here should be equal to 10,500 divided by 105 to the power 770 to the power 180. Do you agree? Can you please help me with these numbers? And then at the end of the day, the price is simply the sum of all these ones here. Okay, you help me. Guys, you help me.
The first one is 493.27.
Okay, perfect. The next one. I need someone to, yeah, go ahead.
469.78.
Perfect. The next one.
447.41.
440.
41.
Yeah, perfect. The next one.
426.10.
Perfect. And the last one.
8,522.09.
09. Perfect. And the sum.
I get 10,358.62.
0.62. Someone to confirm, guys. I need a confirmation from you.
I just get 0.66.
Yeah, that's okay. You know,
It's fine.
two
Yeah.
decimals is fine. Perfect. Okay, guys, here comes the trick. You know what I told you? If yield to maturity equals the coupon rate, the price should be equal to the price should be equal to the face value. Sorry. So this one called is face value. Okay. It's not price. It's face value. So what happens? Well, there is a concept that you need to understand, guys. Take a look. This $500 corresponds to what? To a payment for how many days? So let's assume this one here. You receive $500 because it is a payment that corresponds to 180 days. Do you agree? Now, if you bought your bond here at 130 days, you're going to receive from this 500 only the corresponding piece for the 50 days. And the seller is going to get the interest that corresponds to this period here. Make sense to you? Because remember, the coupon or any interest is a compensation for someone using your money. Got it? So up to 130 days, the one that was giving the money was the seller. Okay, so that's why you need to, from this 500, you need to give the other guy a piece of this 500 for the money that he was lending to the corporation for 130 days. This is called interest in arrears. Okay. How do you compute that? Well, how do we compute the coupon? How do we get this 500 here? So we said simply it's going to be $10,000 times 105, right? To the 180 over 180 minus 1. Do you agree with that, guys? So 180 to 100 is 1. 5%, you get your $500. How do you, sorry, this is my coupon. So let me delete this part here. This is the way I compute my coupon. Right? Now, how do I compute the interest in arrears? Well, it's going to be the same. So what I will say is, what is this part here? The red part here is going to be equal to $10,000, 105, 130 over 105, minus 1. Do you agree? So this part here, guys, corresponds to the interest that goes from 0 to 130 day. 130 day. Do you agree? Agree with me or not, guys? So on this number here, if we have computed everything correctly, guys, this number here is going to be very close to this number here. Can you verify? Yeah, I verified that. Yeah, 65, but that's okay. Correct. So basically, guys, how do we call this price? This price here is called dirty price. The dirty price because it is including a piece of the equation that is not mine, a piece of the coupon that is not mine. So what I need to do, guys, is I need to compute the clean price. And the clean price is simply equal to the dirty price minus interest in arrears. So this is equal to dirty price is 10,358.62 minus 358.62. So my clean price is going to be equal to $10,000 par value. Do you agree? And that's what we discussed. So it is the clean price, the one that is going to be equal to the par value. Make sense?
I do have a question.
Yes, go ahead.
So this 10,358, that is
Yes.
the price that you would have paid for the bond.
Yes, exactly.
At that
you
time.
pay that. You pay that. But you
Okay.
pay that. This payment has two pieces. This payment has the price for the bond, $10,000, and it has a piece that you're going to. So it's basically you're giving from this $500 that you're going to receive in 50 days. You're going to receive this $500. Do you agree?
Oh, yes. Okay.
Yeah, because you have bought the bond here, so you're going to get this $500 in 50 days. But you need to remember that this $500, not everything is yours. You need to share this $500 with the seller because the seller had the bond for 130 days. Got it? So
Yeah,
yeah, go ahead.
The thing that confuses me is that you discounted that 500 only for 50 days. You didn't discount it for the whole 180 days.
No, I have discounted my bond up to this point here. Do you agree? But
So
I have discounted this $500. Another way of doing this stuff is first to compute this number here, and then you simply use instead of 500 the difference between these two guys, and then you're gonna get exactly the same. But normally normally the procedure is this one here. So you assume first of all that you're gonna receive this $500, and then you ignore this part here, like as we have done. So you ignore everything, and then you arrive to this price here. You agree? 10,358. And I did this on purpose because I wanted to. You know that if this is 5% and this is 5%, the price for the bond is by definition $10,000. You agree? Agree or not, guys? Guys, I told you when the yield to maturity equals the coupon rate, then we have a par value. Par value implies that P equals the face value. In here, this price here, this $10,000 here, indeed has one component that is the price for the bond, that is $10,000. And you need to pay more. You need to pay 358 to who? To the seller, because the seller is the one that had the bond for 130 days. Okay? So what you are doing is basically from this $500 in present value terms, from this $500, you are giving this guy $358 to compensate him for being the one that has been lending to the corporation for these 130 days. Make sense to everyone?
Prof, so when you buy a bond
Yes.
at par value, it means that you only bought it for the coupons.
What do you mean?
Because that's the only thing that you're going to really earn.
No. Remember, the bond has two prices. No, sorry. The bond has one price, but it's called dirty price. The dirty price, why it's called dirty? Because it has two pieces. It has the piece that it corresponds to the bond, this one here, the clean price, and it has a piece that you need to give to this guy here. So okay, so let me move this into something big. Okay, so imagine I will do this. This is my 500. This is 180 days. Now, if you keep the bond from 0 to 158 days, how much you're going to get from this coupon? 500, do you agree? Do you agree or not?
Yes.
Yes. Now imagine that you keep your bond. Okay, you keep it, and then here you are the owner of the coupon. Here you decide to sell your bond. You are you hold the bond here, and then you decide to sell your bond. Correct? Then what happens is that you are going to know immediately. Hey, wait a second. So indeed this $500 goes from zero. It goes like that. Do you agree? Yeah, it's kind of exponentially goes like that. Yes or not? So you compound the interest rate compounds per day, goes like that. Do you agree with me? So what you are going to say, wait a second, you know what? At this point here, I should have part of the bond. I should have part of this one here. This part of this one here corresponds to me because I have been the one that has been lending the money in this period of time. Do you agree or not? You need to be compensated for this period. Because remember, the 500 is a compensation for the 180 days. It's not a compensation only for 50 days. Make sense?
Yes, thanks.
Okay, perfect. Okay, guys, we're gonna do one more example in the next class. So now let's take a 5 minutes break, go to the restroom, and please turn on your Excel. Your Excel should be clean, please. Only the Excel that you're gonna have is empty space, empty Excel. You cannot have previous examples. You cannot have anything. Just clear Excel, please. Okay, we'll start in, let's say at 6:15. So you can go to the restroom, breathe for a minute, and then come back.